Hey guys, good afternoon, and hope you're doing well today. We're going to talk about calendar straddles, which is one of the more interesting strategies to use around binary events such as earnings. Basically, it harvests the high IV off an earning event, and has limited risk around that strategy overall. We're going to use a case study involving Microsoft, and let's dive right in. If you have any questions, by the way, about this afterward, just drop in the comments below, and I'll respond to every question that comes in. So, what is a calendar straddle? Well, it's two straddles. So, if you don't, if you're unfamiliar with what a straddle is, a straddle is essentially when you buy a call and a put option, or sell a call and a put option at the same strike price for the same expiration date on a given asset, typically at the spot price. So, if, for example, we have an asset that's $400, you would sell the $400 call option and a $400 put option at the same time. The idea would be that essentially you're trying to harvest that premium off of a lower realized move than the implied move, because the straddle tells us what the market expects to happen, essentially, right? So if we see an implied move, for example, in this case, we're going to talk about Microsoft today, an implied move for the earning event, which occurs tomorrow after close, the implied move for Friday is about $30 roughly in one direction. So that tells us that the market expects that Microsoft should move $30 up or down post their earning event. And how can we profit off of this? Well, a calendar straddle is a very, very interesting strategy to use. It's directionally agnostic, meaning that you don't really care about what direction we go. You basically want us to stay in a certain range by the first expiration date we're going to talk about. So you have two straddles, same underlying and strike price, different expirations. That's the key term here, is different expirations when you talk about calendars, right? You're going to sell the front week or the front month, and you're going to buy the back week or the back month. Typically, with the lower implied volatility, you're buying the lower implied volatility and you're selling the higher implied volatility. If you want a metaphor for this, think of it from the context of, if you're in Florida, for example, and you own a condo or a house, let's say that you could perhaps buy insurance for up to January on, hurricane or flood insurance, but you could sell, for example, the August or the September option expiration or insurance expiration on a hurricane or a flood insurance, for example, where the premiums would be very, very juiced. The idea is that you're covered up to January, but you're essentially short for the August, September expiration. Therefore, if no event happens, if no hurricane hits, for example, in this case, the metaphor there would be that a realized move would be in excess of the implied move. You would essentially win, right? So two different expirations. You sell the near-term straddle and you buy the longer dated one, profiting when the front week implied volatility collapses faster than the back month. And again, this can be there are many permutations of this. You could use front month, back month, front week, back week. You can do shorter term, longer term, many different variations of this, right? But for our purposes here, we're talking about straddles, because calendar straddles, because for earning events, we see immense implied volatility crush post that event. So what happens here, the short leg is selling the front week straddle. This carries the higher IV, collects richly inflated premiums, and also it decays the fastest once the event passes. Then for the long dated expiration, you buy that. Why? Because it has lower implied volatility. Relatively speaking, it is much cheaper. It holds most of its value past the binary event of earnings, and it defines and caps the position's risk. Oftentimes, I get a question, which is, why don't I just sell the straddle if I believe that the implied move is overinflated? Well, the problem is, if you get some kind of 2 or 3 standard deviation move on a name like Microsoft or Google, for example, or a Micron, right, or a SanDisk. We've seen in recent months Micron, SanDisk, Western Digital, Seagate have excessive moves on earnings where they've essentially been repriced based upon new information that's come to light. And when that happens, if you're shorting a straddle, essentially you can destroy your portfolio because your risk is undefined. The idea is to always have defined risk in any strategy that you use. And in this case, we're using defined risk. So the overall profit engine here is IV crush, volatility crush. So before the binary event of earnings, right, what happens is that there's uncertainty, but also there's speculation happening. So many market participants are buying calls and puts, and they're bidding up the prices of those options because there's far too much demand. overall. And so what happens is the option prices typically rise into that binary event. You can see this if you look out, a few weeks before an event, you can notice the IV gradually percolate into that event. So what happens is the front week expiration prices in a single unknown outcome, which is earnings. So its IV is implied volatility is IV, runs far above expirations further out, meaning that essentially market participants are playing the short-dated options for the binary event. They're ignoring the longer-term options, which are then cheaper, relatively speaking, because there's not as much demand for those option contracts. The demand is for the front week or the front month for that binary event. In this case, we have the front week, which is this coming Friday, July 31st. Earnings are tomorrow, the 29th. IV for this Friday is 94.1%, right? Pricing in for the earning event, the uncertainty of an earning event. Then we have the back month, which is August 21st. IV is 45.5%, less than half that of the IV of July 31st, right? The uncertainty is spread out over more time, which is the following 3.5 weeks roughly. After earnings, the unknown event resolves itself in that earnings pass by. We have information in our pockets at that point in time. And what happens? The front week IB collapses, which is the crush. And overall, the effect here is that the short legs will deflate because if, for example, we have a lower realized move than the implied move is $30 in this case for Microsoft for Friday. Let's say, for example, it only moves $20 instead. What happens then is come Friday, that position is trading for $20 overall. You can then buy it back, but you own the longer dated option. Anyways, we're going to discuss this through a case study right here, right? Case study is Microsoft earnings, which we have already mentioned. Spot price when I wrote this was $3.95. I think it's $3.98 right now, roughly. Earnings after close on July 29th, which is tomorrow. The front week OPEX is the 31st, which is the following Friday. Sorry, the Friday following earnings, which is this coming Friday. Spot price $3.95. Earnings release 29th. Implied move plus or minus $30. IV 94.1%. Then we have the back month, which is the August 21st OPEX, 3 weeks past this Friday. The IV there is 45.5%, and the implied move there is $39. So the debit cost of this trade is $9 overall. If you buy this position for August, we'll discuss it in a sec actually, and then you sell this position over here. So next slide is the actual position itself. You sell the straddle for this coming Friday, capturing $30 of credit. Following that, you purchase the August OPEX position, which costs you $9 more than it costs to sell this position right here. So you pay $39. What happens then is a debit cost of about $9 to enter. Give or take like 50 cents per month. Keep in mind, bid-ask spreads across 4 contracts will be probably around 10, 20 cents per contract. So you're going to have slippage somewhere there, right? I'm using this for educational purposes. So bear with me here, right? But again, the point here is that you have about $9 of debit overall, meaning that this is your maximum risk on the trade. So the elevated front week premium will pay for most of the long back month straddle, right? So basically, you buy the spread, or sorry, straddle not spread, for a fraction of its overall cost, while keeping this straddle over here as protection. Again, you can go shorter dated if you want. For example, you could buy like the following week or whatever. But the idea is that you want to have more time and you also want to have lower IV on those contracts because when the IV crush occurs, it will have a far lower effect on the longer dated options than it does on the shorter dated options. So that's the key benefit here, right? So here's the math overall, right? So obviously with the straddle for this coming Friday, the premium at each strike was approximately $15 per contract at the call or the put. Therefore, selling this would yield $30 of credit. On the back month, you have about $19.50 of cost on each contract. Same strike price on the put and the call. Notice the only difference here is the expiration date. In this case, you're selling the back week or back month. You're selling the front week or front month, and you're buying the back week, back month. And overall, you have a credit over here of 30 and a debit over here of 39. Therefore, the net cost here is $9 per position overall. So the P&L that happens on Friday, this coming Friday, is shown here, right? As we go further out of the money, away from the spot price of 395, meaning that we have a realized move that exceeds the implied move. Let's say, for example, we move, $60 in one direction, right? Well, what happens is that the straddle for Friday, this coming Friday, would then be worth, almost $60, for example, which is double the implied move. This is where you need to obviously have um, use your discretion on what assets using the strategy on. Typically, using this on the Mag 7 names is more fruitful. I know for NVIDIA it works pretty well. If you go back and back test this on their earnings, it works pretty well overall because typically the implied move is far in excess of the realized move. So now here, the only way you really lose is if we get a big move in one direction for on the days following the earning event into the expiration of the front week or the front month overall, right? But remember, your losses are capped at only $9, and typically you will not have anywhere near that maximum loss because your longer dated options will retain that much value overall on both the contracts. So within the range of $30 or so, you will actually win. If we get less than the implied move in terms of the realized move, what happens? You see a nice win. An example of this was on Friday. Intel reported earnings, Thursday night last week. Their implied move was $13 in one direction. Spot price was $100 prior to earnings. What happened afterward? They opened at 102. The straddle that was priced the night prior at $13 was therefore priced at about $4.70 that morning. So you could have essentially bought back the straddle. You held the August expiration straddle instead, and it would have yielded a nice little profit there, right? So you, the closer it is to the middle strike after the event, the more you win overall because your longer dated straddle retains that much more value. It'll lose value for sure because, again, IV will crush, which affects all options across the board, but it will lose that much less value because if you notice again, with the IV, we have 94% to crush on the July 31st OPEX, and we have 45.5%. So even if we decline in IV, for example, overall, across all expirations by about 15% or so, these contracts will trade pretty much back at their historical average volatility, whereas these ones will trade probably somewhere below that because the event is gone and there's only 2 days till expiration after that, right? A very, very short window of time to actually make a profit on that position. Anyways, so what happens here? Best case scenario, Microsoft settles near the spot price of the straddle for the front week or front month, 295. The front week straddle decays almost nothing. You keep the credit. The back month straddle retains most of its value and never carried event IV. The spread will realize its maximum gain. In a worst case scenario, as I said, you get an insane move in one direction. Let's say you get like a 2 or 3 standard deviation move up or down, in which case you see perhaps the position go against you, right? But remember that you're holding the long call and the long put for a few weeks out. Therefore, your maximum risk is always defined at your debit cost of only $9, right? So a large move can push the short straddle deep into the money. Often, like a good example of that is Google, for example, from last week. The straddle was pricing in a move of about $22 up or down from 347. So the downside was around 325. What happened? We tagged 315 on the downside, but then we recovered that back toward 330 today already, right? So the idea would be that essentially, if you have a margin account, this is where it's important to have enough margin in your account to actually express a strategy properly. What would happen in the case of, let's say we go down, for example, and the put option is assigned? What happens with when a put option is assigned, right? You're given the share, or you're forced to take the shares in your account. Remember, because you own the put option longer term, you are hedged on your position overall. Your risk is always defined. So you would wait for a reversion back up, perhaps maybe next week, at which point you could sell the shares and pretty much close your position out entirely, right? There are many ways to maneuver it. Again, we're not going to discuss nuances of that because it'd be too long of a conversation. But the point is, this is a good strategy to use when you believe that the IV is overinflated for a binary event like earnings, for example, and you're directionally agnostic. You do not care which direction we move at all. And as long as we stay within that implied move overall, post earnings, what happens? You end up realizing a nice little win overall, right? Um, And again, you always risk define the entire time. So the pros here, again, advantages, defined limited risk, max loss equals a debit paid. Um, you can monetize the IV term structure gap. Low outlay overall. The front premium finances the long legs overall. Positive theta on the short leg into expiration. Profits from the near certain post. Sorry, profits from the near certain post earnings IV crush, because again, we know that once the information is out, no one is speculating on a move the following couple of days such that they are bidding up the prices of those options, right? Either they're going to be have been long contracts prior to the earning event, in which case they are taking their loss of their profit the following the event, or they were short those contracts prior to the event, in which case they're buying them back or allowing them to expire worthless. Now the risks here are a move beyond the implied range erases the profit. The best outcome needs a price of pin near the middle strike. The long legs IV can fall too, trimming its value, which can happen for sure. But again, at a more muted rate. This is why it's important to analyze the term structure on a given option, a given asset, for example, because you want to ensure you're selling the right term and you're buying the right term as well. Because if you sell, for example, a low IV structure and you buy a high IV structure, let's say you're buying like the back month, which factors in earnings, but you're selling a front month that doesn't factor in earnings, you're going to be in trouble perhaps, right? So keep that in mind as well. And then next you have possibility of early assignment, which is a possibility for sure, because keep in mind, no matter what, you're going to be in the money on the call or the put at all times, right? And then last thing is it requires disciplined timing around the event overall, right? Because after the event, kind of like with Intel, for example, on Friday, the morning of, the straddle was $13. It opened up at what? $4.70. If you had purchased it back, you made a nice fat profit off the hop. But what happened following that, it fell down to about $92, and it was at $8. Today, it was at about $86 at one point today. So that meant that it traded for as high as $14 following the binary event. So the idea and the lesson here is you do not want to hang on to this for too long after the binary event itself. You do want to close it out and move on to the next position again overall. That's pretty much it. Yep, risk is defined. You went on volatility mechanics, not on calling market direction. If you have any questions at all, drop them below, and yeah, I'll reply when I can. Have a great day. Thanks for watching, and we will see you guys next week.